My name's Jordan Pence. Uh, our company is Advisors Resource Company. And today we're talking about some strategies specifically for your business owner clients that'll really help them save save tax dollars, save for retirement, and so forth. And it's just now 3:30, so I think I'll get going here. This is a pretty complicated strategy, and I'm really not going to be able to do it justice, I think, in this short time period. So I'm going to get kind of an overview of like the process and some of the benefit, and I'm going to go through it a little fast. But I think the main thing to remember is how this can benefit your clients, your business owner clients, that sort of thing. So, anyways, before we get started, our company, Advisors Resource Company, founded by a former chief actuary, and was really founded to help agents, you know, uh, in their businesses do the things that are challenging for them, and that's generate proposals, do case design, take paperwork, handle servicing, that sort of thing. And that's kind of what our company was born out of. You can see our core values up there, and we just have a simple process. We call it the Premier Producer process. Consists of the things on the screen, so competitive products and top compensation, tailored yet simple client presentations, case design and consultation. We take the applications for you. We help you with underwriting, and we have a process to manage in-force business. So that's kind of our brief process. But anyways, what we're here to talk about today is the MSO split dollar strategy, a strategy to help business owners save taxes. And really, the target market for this is income 500,000 plus, generally under the age of 60, but I've done a couple for over the age of 60. It's not really that big of a deal. And then excuse me, we say they've outgrown their S corp, and what I mean by that is they're leaving income in their business. They don't need to take all their income out of their business to live off of and that sort of thing. So, anyways, again, this is going to bring about some big tax savings. So, um, first off, I don't know if this is necessary to talk about right now, but I always get asked this question: MSO, what does that stand for? And really, it's a company that we're going to set up on the side to lower income taxes for a business's LLC or S corp, whatever they're operating out of currently. Stands for Management Services Organization. So more on that in a little bit. Um, First step is, how are your business owners currently? Almost all of them are some sort of pass-through entity. So what I mean by pass-through entity is they recognize the income from their business on their personal tax return, and they pay ordinary income taxes at that level. Almost always, if they've got at least a decent CPA, there's some sort of S corp or some sort of other entity that allows them to reduce their payroll or their self-employment tax. So in this circumstance, if you have a business owner in their S corp that's making about $1 million, they'd recognize some of that through their W-2 wages. They're obligated to pay W-2s to themselves for whatever they're doing for the company. And the rest of that flows through on, generally referred to a K1. And the upside with this is any profits they have, they're allowed to take out of that company with no tax consequences. And downside with that is, well, any any profits you make in your company, you pay whatever you're paying personally. And generally, that's not a huge problem, especially when you're a really small business, but it becomes a problem when you're making more than what you're consuming. And I think that's an important consideration here, is if you're making more than what you're consuming, then there's a case to be made that you should only pay taxes on the money, or you should only pay top taxes on the money that you're actually going to use to fund your lifestyle. So that's really where this type of strategy can work. And that's where this comes into play. It's like those business owners that are earning more than what they're consuming. And by consuming, I mean spending on their lifestyle. Um, so that's where this really is effective. Now, um, I think I'll move on from there. One thing that we need to address, because we're going to utilize it in this strategy, is the taxation of C corps and why CPAs, accountants, tax people typically don't recommend a C corp. So the difference between your pass-through entity and a C corp is the C corp pays its own taxes. So in this case, C corp earns $850,000 of profit. It pays 21% in tax. Your W-2 is the same as it was on a previous page. And this is great. But the problem here is when you distribute that money, you can't just go into the C corp and pull that money out. You have to distribute it, and that's either through a dividend or wages. So that's what you got to take into consideration is with dividends, you pay the corporation tax and then you pay the dividend tax, and you'll hear it incessantly from accountants. It's the double tax, double tax, double tax, double tax. I mean, that's what they'll talk about. And I mean, the double tax is a problem, but it's not as big of a problem as they make it out to be. It basically gets you right back up to top tax brackets. So if you're already in a top tax bracket, it's kind of a wash. But anyways, that's another point for another day. But this is why accountants, etc., tax people don't typically recommend C corps in general. So I guess going back here, I'm not suggesting that the business owner moves to a C corp. What I'm suggesting is we leverage C corp taxation. And you're probably wondering, where does the insurance come in? I'm almost to that. So really, what we do is we set up an MSO on the side of this LLC S corp, and we bifurcate some of their business over into this MSO. So it could be a marketing company. It could provide, HR services. It could provide various things that this entity may need. It could be, yeah, marketing is an easy one. So it could be a myriad of different things. Management of this company, different services that it's going to provide. And in this circumstance, this company is going to earn exactly, which it would probably wouldn't be exactly this. It would earn exactly 126,000, which happens to net down to 100,000 in this circumstance. But the idea is that we're shifting money from the S corp to the C corp, lowering the tax bracket from, if you're in the top tax bracket, from 37% down to 21%. In this circumstance, it's a savings of over $25,000. So that's quite substantial if you ask me. And you don't have the complexity, you don't have the restrictions, you don't have anything else that comes along with the expense of like a qualified plan, for example. So I guess normally the question is, I just spent a lot of time talking about these various entities and, well, the C Corp's got this problem with the double tax and so forth. So what do you do? What do you do with the money once it's in the C Corp? And I got a question, and it says, can the MSO have the same leadership or management as the LLCS Corp? Yeah. Yes. Yeah. It's no problem. I mean, I can have two companies that do different things. It's no problem. In fact, it would almost always have the same owners and management. So then moving on from there, what do you do with the money once it is inside the C corporation? This is where the insurance comes in. We call it equity transfer only because split dollar sounds kind of dumb in my opinion, but we have an equity transfer strategy, which I think sounds better. But anyways, we take the retained earnings inside the C corporation, and we put it into an insurance contract that's owned by the business owner. The business owner gets the growth on that policy with no tax consequences. They are obligated to, because of this arrangement, I mean, it's so beneficial. They're obligated to pay a little bit of economic benefit tax, which you can see down below. And the C Corp, in order for this to not be taxable, gets a collateral assignment back to it of 100,000. So C Corp puts in 100,000, collateral assigned back 100,000. And, we're going to use an index policy inside of it. So you should have some pretty decent growth along the way, and it'll grow tax deferred. And then when they take it out, they don't have to pay taxes on the growth. So what I've done here is I've created a way to fund this insurance policy with money that was only taxed at 21% instead of 37%. So straight up from the beginning, I'm working with 79 cents on the dollar instead of 63 cents on the dollar. So I'm well ahead of where you would ordinarily be from an after-tax basis. And typically we'll just compare this to saving that after-tax dollars in a mutual fund account or equities account and so forth. So that's really the main thing. I mean, the split dollar, there's some nuances with that along the way that are kind of like maybe outside of the scope of this overview, but it's really just, you're setting up two companies, you're separating your company, and you're earning income in a different type of entity known as a C Corp that reduces the tax rate down from 37 to 21%. So the way I like to put it is you pay half the tax now and all the growth is not taxable. And as you compare that to a qualified plan where you get all the deduction now, yet you pay all the tax on the back end, which would you rather do? So anyways, if you have any questions on this, feel free to reach out. I'm going to get my contact information up here, and we've here's my contact information. I'll stick around if you have any additional questions, and we'll go from there. Thanks everybody for joining me today, and I hope you found this overview interesting.